Okay, let's get started, guys. I'm sharing something that you guys already have access to, but I want everyone to just keep this as a guide for when you guys are having a conversation with your clients. I don't follow it to the T, but I do still use it as a starting point for any customer conversations that I end up having. It helps me understand um, what my flow of communication should look like and how much, if any, am I deviating. So today's session is dedicated to customer conversations. The purpose of elaborating on customer conversations, and I know you guys have already done part of this course in your initial training when you go through the learning system. But it's important to understand the one that we're focused on today. And the simple reason is there's a lot more that's happened since we focused on customer conversations. Now the conversations are getting more detailed. Now there's a lot more awareness that consumers have, and those questions have to be addressed on an ongoing basis as well. So the best way to do this is to keep adding more content to it, and this is one of the ways we're going to do that. Um, I'm struggling with getting that document in, but I will leave a link. Sorry, just give me one quick second. Okay, so I've successfully uploaded the file for you guys. It's a mortgage agent call flow script. You guys have it accessible in your agent resources as well. But every now and then it's a good idea to kind of hold the script up against a mirror, in front of a mirror, and then recite through it. Um, when I'm having conversations, or when anyone else is having conversations in the mortgage industry, things tend to go awry. Things tend to go into a different direction, and that call flow script will help you realign what the intent of that conversation is. Um, every now and then, it just so happens to be a conversation that's about rates or that's about process, and to be able to realign that conversation, you got to stick to the flow. Sometimes you give out too much information. Primarily, you don't need to share a lot of the information, and it can backfire on you as well. So as long as you're following that flow, that kind of helps you keep things organized as well. Rosie, I'm not sure if we have the screen pulled up for the presentation.
Sharing the screen now.
Okay. All right. So we're going to start off with our customer conversations presentation today. Starting from the very get-go, whether you're selling a fridge or a freezer, whether you're selling a car, or whether you're selling a mortgage, the cycle of the call flow or the sales process doesn't change. So when you're looking at specifically your actions aligning to lead generation or application intake or document collection, it always, on a broader scale, takes into consideration the pitch, probe, rebuttal, close process. The pitch is when you identify yourself, you identify your company, and you produce an offer. Probing is when you ask a lot of questions about their situation, and that should be close to about 50 to 60% of your call. Your rebuttaling process is to help the customer identify the benefit or the value addition to your service that you're bringing to the table. In many scenarios, you're going to struggle with a client talking about interest rates or a client talking about another offer with another lending institution. So a rebuttal is framed in a very specific way. It is addressing the specific concern, attaching what you're bringing to the table, and then offering a trial close to it so you can try and attempt to take in the application. And a close is essentially when you try and get the application through the gates, whether you're doing it by sharing additional information, whether you're creating a process out of it, leading them to an action is what we call a close. So I always try to have an interactive session. If you guys have questions, raise your hand. I'll allow you to talk. We can discuss it. Or if you want to just leave a question or a comment in the Q&A, I can get back to that as well. Next slide, please. Okay, so understanding the customer's requirement, differentiating between needs and wants. In the current market, my best rate right now is a 4.89, which is a fixed rate on an insured deal on a 5-year term. I want a 4.39. That's a want. What you actually need is the best rate in the market. Or perhaps I want an offer from TD and I want an offer from RMG, just so I can compare what the product variation would look like between TD versus RMG. The clarity that you have to offer your client from the very get-go is that we're working for you, and identifying their need on the basis of the product is what you're going to create value with. So if you're doing a private mortgage, then the value associated to it is I have access to a number of lenders. When you're working on a renewal, you're trying to eliminate the number of steps that you have to completing that as a transaction. When you're doing refinance, you're showcasing the benefits associated to reducing the cost of borrowing, or by reducing, by improving their cash flow, by consolidating their debt. So the difference that you create in those conversations are what drive you and your customer to the end goal, which is to actually try and complete it. For purchases, there are two different angles. One is prepping for pre-approval, and the other one is when you're actually focused on an actual purchase, when you have a live purchase agreement. So those conversations tend to differ. The conversations around purchases are more relevant to, the conversations around pre-approvals are more relevant to when a client wants to understand their maximum budget, when they want to understand affordability. So there are certain things that you do say and you don't say in case of a pre-approval. For example, let's get your numbers in. I want to take a look at the paperwork. I want to understand where you stand right now and how we can improve and get you a maximum budget or a bigger budget. There may be a situation, more likely than none, that they're going to be shopping or they're going to be looking at another opportunity with another financial institution. So if that were to happen, you need to create a value component to it. So when you're talking to a customer, do you currently have any number crunching that you've done? Or have you visited your bank? Or have you spoken with anyone about your maximum budget so far? And then they start opening up. The difference that I'm trying to create now is that conversations around having a very open communication and not getting bogged down by their questions is key to having a successful call and being able to close that call. If you're going to answer questions that they have, and that's the extent of that conversation you're going to have, you're going to corner yourself into a situation where you're only going to be a customer service representative and you're not actually going to be addressing the sales angle of that phone call, which is why you need to be the controlling factor when it's a purchase pre-approval. Target on those specific points. I'll also give you an example for a purchase which already has a live agreement. This conversation is going to be past the point where their affordability is, past the point where the minuscule details of what the approval would look like, for example, whether it's going to be a 25-year term or whether it's going to be a 30-year term. By now, you should have passed on to, hey, what's my rate looking like? What's my payment looking like? And how long is it going to take for me to be able to complete this transaction? What information do you need from me? So again, a very different conversation for someone who already has a live agreement. Next slide, please. I wish I had control over this. All right. So working with a customer, what you need and why do you need it? A lot of clients talk to me about various angles of how to avoid an application with me. And I'm sure you guys struggle with that or you come across the same situations. The purpose behind the application between you and your brokerage as clear in communication, clear information is you're not going to be able to work with a customer if you don't have an application because the customer has not shared his trust, his interest with you by producing an application. If you don't have a signed application, then they're just looking around. They're just looking for free information, which is great, which you can offer as a customer service angle, but don't expect to make a sale out of it. If you start with the application and if you make it into a mental process that my starting point is to start with the application and understanding what exactly is going to show up on that application, using that data to process their needs and wants, it will help you build a case around it and you will come back with more factual information. That's an education for you, and that's to also help you educate your customer. Mr. Customer, the purpose of the application is to get a very clear understanding of what you qualify for and where we can place you for your mortgage needs. Whether you're going to qualify for an A, B, or a difficult transaction known as private, it depends on what you put on that application. If we have the ability to assess your GDS TDS by what you've provided on the application, we can come back to you and share a couple of options and figure out what the best solution would be. Many times clients will not agree to that and they'll move on. When you have a customer that's not wanting to complete an application, chances are, and I want you to try this out yourself, go back to the customer and immediately ask him, okay, so you don't want to do an application. I understand. You don't have to. I'm still happy to share the information with you. Are you currently working with someone on the side as well? Or do you currently have a pre-approval in place already? When you ask that question, 9 out of 10 times, you're going to notice that the client already has a secondary option. If banks require an application to begin with, if other brokers require an application to begin with, then what's stopping you from getting one? The only thing that's stopping you from getting an application is you. So how well you communicate that need as a starting process is how easily you'll be able to establish that relationship and get the ball rolling for your client application to come through sooner rather than later. We used to have a lot of concerns around online applications or paper applications. Nowadays, it's as simple as do it online. Many times, you're going to notice that the client will prefer to do an online application. It's just easier, it's faster, it's in a stepwise format. It even allows you to be able to upload documents now. So all those things play well to your benefit for the purpose of getting an application and working on it very quickly. Don't shy away from paper application. We still do some paper applications because in case a customer that we don't feel very comfortable with, we want to tie him down with a contract and we want to make sure that he's committed to it. We're going to send out a paper application that requires e-signing or electronic signing or wet signatures. And we bind that customer with page number 3, which is our service agreement. To be applied in cases when you know the client's going to be difficult to hold him down. But even then, there's no guarantees on whether he will or will not proceed with you. But it does protect you. It protects you with the right information. It protects you because you know that this customer is going to share the information where you can at least have an open conversation. And you've already crossed the first barrier. You've crossed the path of the highest resistance where I don't want to share my information. Now that you already have the application, the rest of it is just going to start flowing naturally. Next slide, please. Okay, so requesting documents is fairly easy now, but the reason I wanted this, excuse me, the reason I wanted this to be a part of our education was because agents get inundated and overwhelmed by the amount of information that they have to ask for. So I'm referencing our color-coded checklist for the documents required. And if you're working off of that, beautiful. That's exactly what you should be doing. But don't feel like you have to ask for everything right off the bat. Pace it out. Don't force the customer to provide everything up front. Pace it out. That's the number one reason why many clients feel overwhelmed based on the amount of information that's been requested right off the bat, and they shy away from actually continuing with it. You've done that. I also do that. Recently, I was asked to provide my investment statements for the purpose of an investment transfer. That email is still sitting unread in my inbox. I haven't gotten to it. Your ability to be able to get information quickly depends on how you curate the kind of documents you need. So if it's a purchase and you already have a live agreement in place, then start with that. Don't worry about the IDs. Let's the purchase sale agreement and then request the MLS. It's going to give you the important details that you need. It's going to give you the purchase price. It's going to give you the closing date. It's going to tell you how much time you have for the waiver. It's also going to share with you the MLS details, what the property taxes look like, the extent of what you need to be able to start doing a GDS, TDS calculations on it. So if you're using Finmo, many times it's going to send out, actually it always does, it's automatic the moment if you already turned it on. And keep in mind, you can turn it on and turn it off. In Finmo, there's an auto document request that goes out to the customer the moment they complete the application. And that list can be very overwhelming. So if you want to reduce that count, do so. Don't shy away from just leaving it as is. If your Finmo request is going out and asking for T4s and NOAs and everything on earth, then stop doing that. That's one of the reasons why people are not sending out all the paperwork. It takes time to collect and upload the documentation. So if you were to phase it out based on stage 1, I just need your purchase sale agreement and your MLS. Let's get that in first. Second stage, hey, can I ask for your letter of employment? Beautiful. Let me get that in. Let me process that. You start building out your GDS, TDS. And you don't have to collect the paperwork over a period of 5 days. You can still work on it fairly quickly, and your communication is what helps you get to that point faster. And this is one of the reasons why we use the NanoQuote CRM, because the system is automated to a point where it sends out the text message, and you can use that for real-time communication and just have a very nicely worded text go out, which is very natural induced communication style. Hey, I am working on, I received your MLS and purchase sale. Thank you. Do you have access to a recent letter of employment or a job letter you may have requested? Can you send that out, please? And you'll notice that that step-by-step communication is what helps you recover the documents fairly quickly. We have adopted the same process for ages. We do a bang up job of collecting documents. We have a 95% close rate on every customer that walks through the gate because we know exactly when to request the documents. And we're asking you to do exactly that. If your customer is self-employed, then you don't really have a choice but to ask for the T1 generals and the NOAs. However, you can ask for the T1s, and it sounds like you're just asking for the one document, and that's it. And then the T1s automatically have the final number on them that outlines your line 15,000. So if it really ends up being your final amount of income that you're looking for, it's already to prep your file. And then as and when required before submission, obviously you can ask for additional paperwork. Now, many clients typically hold that as a package. When I get my documents, when my clients get their documents, they'll save it from their accountants in a folder. All the NOAs, all the T1s go in a specific box. So if they have it accessible, by all means, ask. But that's where your communication comes in. Don't feel like asking for documents is a bad thing. You're working on their benefit, to their benefit, on their behalf. And that's why you should be able to have an open conversation about, well, I'm going to need this, but let's start with this just to get the ball rolling. And that way you'll open up the customer a little more to level with you, to help work with you side by side, because it's a team requirement. It's a team effort. If you're doing this by yourself and if you create a list, then he's going to be fumbling with the list and trying to complete the document list and may not be able to. So that fear factor settles in between you and your client, where the customer doesn't want to come back to you and tell you, oh, I'm missing this. They should always be able to pick up the phone and talk to you about what their concerns are, their problems are. And if you're blocking that out by that long, lengthy list of overwhelming set of documents, then that affects your customer's relationship with you. Next slide, please. All right. So when we're having a conversation with a customer, we've broken this into 5 parts to help you understand what to say when. And let's just address the first part of the communication. And as the file progresses, it stages out from having received an application into document collection, into review of the documents, into perhaps you're working with the underwriting team, so reviewing the file with the underwriting team, into getting all the paperwork ready for submission, and then discussing a solution, moving on, taking that solution back to the customer, getting a consent from the customer if we're good to move forward with that, and then finally the commitment stage where we actually print out the paperwork and send it off for signing. So that entire flow has components of what you should say, what you shouldn't say. So let's talk about creating a solution, because that's a part of the pitch, that's a part of the sell. And going back to the basics, pitch, probe, rebuttal, close, the pitch needs to contain some level of value associated to what you're going to be helping them with. So creating a solution is based on a needs assessment. So if it's a purchase, if it's a refinance, we're going to use those 2 common examples. For a purchase, the intent is to find them the best deal, the best product available. So understanding, and you're not giving out information at this point, you're asking these questions. Understanding, are you planning on staying this property long? Are you planning on renovating it? Do you feel there's a family addition that you're expecting, that you may need additional room, or you may need to upgrade at some point in time? What does your budget look like if you wanted to add in a renovation associated to the new property that you're entering into? Sometimes even new builds have a basement requirement that the client has, and I've been asked many times, can I get an additional $15,000 on top of my 80 LTV that I'm already getting? And the answer is no, but at least you know that that's what the client is expecting. And making notes along these lines help you in the long term, because at some point in time, 6 months down the road after that closing, you can still go back to them and tell them, hey, I see there may be an increase in the property value, which is why we should still look at a line of credit component. But that building a solution for them comes from asking questions. So ask all the questions that you can to understand their need, and then create a solution around that. Addressing the need. So if a client is looking for the best rate on a purchase transaction for a deal that's closing in about 4 weeks, for argument's sake. So the most important thing at this point to address is timing. And it could be different in each case scenario. But I'm identifying for you what is the most important need that the client has that should be addressed right away. Timing. So, Mr. Customer, when we work with lenders, different lenders offer different rates on the basis of how quickly they can churn out a commitment, how backed up they are, how easy they are with the conditions and the completion of the file. And some lenders will have the capacity to host all those concerns, and they will be able to help you out fairly quickly with a great rate. But some lenders are more focused on the rate, but they will take forever to close, and they may ask for additional paperwork. So how important is timing to you so that we can identify the best product for you? Take a step back now and think about it. You didn't put him in this situation of a 4-week closing. And just because he has a 4-week closing doesn't mean it automatically requires you to work with that. You will accept the file once you know that this is a file that's doable. This is a file that you can actually manage with reasonable expectations. You're not going to lose sleeps over this. You're not going to rush the file. You can't really do much once the file is sitting in underwriting or sitting with the lender. So there's only so much of a rush that you can apply on that. With that in mind, if the client is adamant over the 4-week timeline, this is the perfect time to take a step back and educate the customer. Mr. Customer, lenders operate within this capacity. If I try and push this any sooner, it may trigger a fraud alert, which is going to end up taking even longer. So we either look at an extension or we look at a lender that can accommodate your request, and rate will not be a priority. And addressing those needs help the customer understand. Now, granted, the customer may end up going back to another lender and asking if they can do it any faster, but you can't stop that from happening anyway. Even if you were to say, yes, absolutely, I can fund in 4 weeks, no problem. There's no telling that this customer is not already speaking with another broker to try and have a backup ready behind the scenes anyway. You can't control it. So setting the right tone, setting the right information up front is important for your deal and for a proper closing. Talking about costs. With new agents, we find this is a fairly big concern because they are not privy to the variations that may apply in a closing. And let's talk about very quickly the basic closing costs associated to getting a deal done. If it's an institutional transaction where you would qualify the deal as an A lender, there are no charges applicable, but you're still, as a customer, responsible for the appraisal in some cases. If it's an insured deal, chances are CMHC or Genworth, or Sage and Canada Guarantee will price out the property in their AVM system and kick out a value so that you don't have to jump through the hoops. Sometimes insured deals end up being private deals as well. And if that happens, you will require additional time and an appraisal to proceed as well. In some cases, Rate Shop will cover the cost of the appraiser. Now, moving forward, if you have an insured deal, your other costs associated, which sometimes are not explained by real estate agents properly, are your inspection fees, are your legal fees associated to completing the transaction. And sometimes there may be an additional cost for perhaps there needs to be some costs for buying out a rental that they have, and you don't want to deal with that cost. So that could, for example, a hot water tank. A hot water tank can cost you as much as $900 to $1,500 just to pay out as a contract. Or sometimes it is not on a contract and it is fully owned and it needs to be replaced. So sometimes the buyer will get a credit and sometimes the buyer won't get a credit for a replacement for that unit. So those variation of costs, even though they're the responsibility of the real estate agent to disclose and advise on, sometimes end up being a cost for you. You don't have to disclose it on a borrower disclosure, However, you do have to have a conversation around it as well. Legal costs typically range anywhere between $1,200 to $1,500. They're higher when you have private transactions involved. And the reason they're higher is because there's a lot more paperwork, there's a lot more liability on private transactions, and the title insurance has a much heavier cost associated to it. So when you bundle all of that, the amount of work that goes into it, and ideally the main header under the category of costs for a private transaction on a legal cost should be just the liability angle. You end up paying close to about $1,500, $1,800, $2,000, $2,500. I've even seen $4,000 as a cost in some transactions. It was a larger transaction. It was about $2 million of a private mortgage, and they had to have a very costly title insurance for the purpose, and that's why the legal costs were much higher. So educating the customer with a range of estimates is important. Now, agents, when they come back, they also get confused in the cost of borrowing document about an appraisal fee that may or may not be applicable to the customer. And it's at that point in time you have to explain the customer ahead of time so they can be prepared for something along those lines on the form of a commitment or a cost of borrower disclosure document, that they know that this is a cost that was outlined initially and may not be applicable to them. Why do we have to add it? Many times we just cover our rear by adding it. If for any reason there ends up being a problem with the transaction where the lender comes back and says, oh, this property is right next to a truck station or a truck stop, or the property is right next to a gas station, and we would like an appraisal, an independent evaluation, as well as a perspective from an appraiser to outline what the costs, what the risks associated to a property being right next to a gas station are. So in that case, you will have to last minute request an appraisal. It doesn't happen often, but it's an important point to note that, listen, if you had an appraiser, this is what the cost would be, and it's typically borne by the client, and that's why we've outlined it. There's one more cost specific to insured mortgages, which is something that people generally forget to talk about, to discuss. When you're doing an insured mortgage, we had a post today, I think, or maybe it's in production, I'm not sure, which outlined your CMHC premiums. So when you're doing 5% down, it's 4%. When you're doing 10% down, it's 3.5, I think. But that premium in itself also has an insurance HST associated to it. So though the insurance premium is the responsibility of the bank, where they're going to add it to the balance, the HST for that total is not. So on an $18,000 worth of insurance premium, you can easily expect 13%, close to about $2,200. That's going to be coming out of pocket. That is something that will show up with the lawyer. And if you gave out estimations based on, hey, your closing cost as a new home buyer, you're only going to have to spend $1,500 or $2,000 for your legal fees, that may not be accurate. This will backfire. So that's one of the reasons why those costs have to be advised ahead of time. So specific to insured, we've touched on almost all of them. Let's talk about B lending. For B lending, generally you end up charging a fee and you have a lending fee. So that lending fee coming from the lending institution for the purpose of advancing the mortgage is what we call a commitment fee or a lender fee. That is typically 1%. Sometimes on open transactions, it's a little more. But that is something that you have to disclose ahead of time as well. What is your fee? You can put in a range. You don't have to commit to exactly what it is, but if the client is comfortable with just a range, you should be fine with that. If you want to be specific, when we are doing our transactions, we put it out very bluntly. It's about 1.5% for the cost of getting the deal done. If we have to jump through many hoops, which we typically do, if you guys have been in the industry long enough, then you'll notice that over the last 5 years, especially since COVID and since income consistency has been an issue, they're probing more, they're asking more questions, they're digging in more. The market is also responsible for that kind of an attitude towards underwriting, but they are spending more time per file. So for example, we have a file right now with Home Trust. They want to look at the appraisal. Even though they've issued a commitment, they still want to look at the appraisal before they can allow an exception. So generally, we send out all the conditions in a single shot, and then they work on it, take a couple of days, and wrap it up. Right now, before they clear out any of the conditions, they want to first take a look at the appraisals. So the point that I'm trying to make is that when you're charging a brokerage fee, it should be in line with the number of hours that you're dedicating. And the typical cost, when you add the errors and emissions cost, marketing costs, your time at perhaps 30 to 50 bucks an hour, all in all, you end up costing about $100 per hour. So if it costs you about 35, 40 hours, then you should be charging about $3,000 to $4,000 as an additional fee for that client. Sometimes it can take longer. Sometimes it can take a month to close the deal because there's a back and forth with the client or a back and forth with the lender. So it could end up being a little more. So when we talk to our clients, we say generally you're looking at a 1.5%. If there's anything that we can do on that note, we will. And we generally do. If it's been a fairly easy ride, we will discount it and we will reduce it for you. But that's between you and your client's relationship, how you can negotiate that. Our expectation is if you're doing a B deal, we typically ask you as a suggested fee, it should be roughly around 1% as a minimum. Since we're talking about fees and how to educate clients on that, let's also talk about private. So generally speaking, when you're looking at private transactions, you're looking at on seconds about 3 to 4%, typically what you would charge, and your loan amount should be anywhere around $50,000 to $100,000 for that kind of an income. If you're looking at a first mortgage transaction, it should be anywhere between a minimum 1 to 1.5%. If you have to put in a lot more as an effort, then you can charge a little more. But my thought process is always, don't be greedy. Make sure you can justify it. So if I come back to you and I ask you, okay, you're charging $10,000 on this transaction. How many hours did it take? How many times did you have to communicate with the client? What were the hiccups? What was the reason why the lender A, B, C, D that you went to didn't want to do it and you had to switch it around 5 different places? Those reasonings will help you determine whether this cost is suitable or not. And if the answer is just because I wanna, that's not good enough, because FSRA is very tight, very strong on suitability. Was this mortgage a good product that the client entered into? Should that have been offered to the customer from the get-go? And if it wasn't, if there's a determination by subject matter experts, including me on the advisory committee, if we were to look at a file and if we were to deem, hey, he could have charged maybe $2,000 less, there have been penalties that have been issued along those lines as well. So be very particular about your charges. Don't overcharge. It also points to your relationship with the customer in the long term. Explaining these costs is fairly easy. Mr. Customer, it's going to take roughly about 2 to 3 weeks for me to be able to convert this transaction. I have to reach out to X number of lenders. I have to convince them, and I have to underwrite the file to get you an approval for the purpose of your financing request. And these are the problems associated to that transaction, which is why I feel my charges would be justified. I've kept my charges very competitive. If you find a better deal elsewhere, obviously I'm going to accommodate, but these are the best charges that I can apply. If there's anything that I can do further at the time of the commitment, you won't have to ask me. I'm going to do that upfront for you anyway. And make it a habit. If you're charging, for argument's sake, $5,000, discount it. Manage the customer, retain the customer. Count it as a cost of just having to retain the customer for the next year, so that this customer doesn't feel like he was pinched and he still comes back to you before shopping around at the time of renewal. Explaining the costs for privates can be dodgy because sometimes you don't have a clear understanding. That's one of the reasons why we always ask you to start with an appraisal. So if you have the appraisal, you can in real time go through your private lender list in your agent resources or lender spotlight, and you can get a sense of what percentage as a fee you should be charging. I look at some of the deals coming in through LendMax, and I was forwarded a deal where we were okay to do the deal, and our charge was going to be 2.5% as a lending fee, and 9.5% as an interest rate for a 75% loan to value. And in the notes, the agent had requested, and this was another brokerage agent, he had requested match lender fee. The lender is forking out more than $500,000 as a mortgage. The lender is taking a risk. The lender has a return to offer. It is not advisable for you to match that fee. You should not be charging 2 or 3% on a first transaction that was fairly easy to do. And what I mean fairly easy, when I say fairly easy, what that means is your generic criteria, most traditional MIC lenders will go up to 75% loan to value if it's a cookie cutter deal. And if that's what the case is, then keep your commission limited to a 1 to 1.5%. If it's very hard to achieve, then you can tack on maybe another 50 basis points, but cut it off there. Anything much higher than that, the lender will also come back and tell you that, hey, we're not comfortable with you charging 4.5 points. There's no way to manage the serviceability. It's going to be a huge deduction out of the proceeds, and that can backfire on the lender as well as on you. And that's one of the reasons why level 2 has been introduced for private transactions, so that there's a lot more onus. Now that you went through that REMIC course for $200, now that you've gone through the motions, you've qualified, now they can penalize you and put the onus on you that you should have known better. And that's one of the reasons why explaining the costs for any case scenario should be done either in person or a very elaborate phone call when you know the client is not just going to go in the opposite direction when hearing the costs. It's important for me to note that your cost estimation should also be done once you've had a chance to review the file, discuss it with your team, and you know what kind of a solution you're looking at. If someone were to call you off the bat and say, I don't want to do an application, can you just tell me what your fees look like? Then the answer should be, I have to take a look at it and I have to price it, and I can get back to you once I know what we're looking at as a costing. So that at least puts you in the right direction of getting the app and getting the appraisal going. Always go back to your client with, I'm referring to number 4 now, always go back to your client with a couple of options. And this is important because clients don't want to feel like they were led to a rat hole and they're stuck with something that they have to get into as the only option. Even if the other option is not lucrative for you, you're still required to present it. So how you shape it is, Mr. Customer, this is option A, this is option B. I feel option A is better because it could be faster. They have a simpler underwriting process. The completion is going to be quicker. You'll have access to your funds easily. They're not asking for too much documentation. They won't make us jump through hoops. They don't have high fees towards the exit. All of those reasons can be applied to explaining the alternative, and then you can help the customer decide on what product to go for. At the end of the day, it's their decision. So even if you're losing a couple of $100, it's fine. Push the deal through, get the deal done, do right by the customer. Now, some people have come back to me and we've had conversations around doing right by the customer. At the end of the day, you're running a business. There's a certain amount of time that you dedicate, which comes at a cost. There's a certain amount of effort that you apply, which comes at a cost. And there are things that you have to do to make sure that the deal gets done. For all of that, you should not have to negotiate on what your costing looks like. We don't, and we still have deals pipelining. So if you don't want to, that's fine. But be flexible to a point where if it's a couple of $100 here or there, don't pay any heed to it. Just let it ride. You have to get to a point of performance where you can dictate your terms on fee structures. People, when they come to me, I say, this is what the costing looks like. I don't gouge. I tell them up front, this is what my pricing looks like. This is what the cost of my time is. They're usually comfortable with it. The ones that aren't, they don't work with me. Committing a customer. Before you request a commitment and before you finalize the offer with your underwriting team, or even when you're speaking with your lender, you have to juggle and hold two forts down at the same time while discussing with the lender that, listen, let me get back to you. I don't want to waste your effort. Let me figure out whether the client is actually committed to this deal or not. At the same token, you have to manage the client. Mr. Client, we're still churning. We're still working on the approval. They've given me an estimation. I don't know for a fact if it's 100% yet or not, but we're working with them to finalize it. This is what the pricing is coming back. Is this something you'd be okay with? So for private deals, we actually collect an admin fee or a retainer if you're pushing it through LendMax Capital. If you're pushing it through Rate Shop and we have a MIC, then MICs typically charge a $500 to $1,000 fee, and that is what we call committing a customer. It's harder with B deals, and it's even harder with A deals. So with A deals, the only thing that you can actually refer back to is, Mr. Customer, once I request a commitment, I can't go back and forth because that puts our lender's relationship at stake. We work with the lenders to get you the best deal, and we have a contract with them that outlines our funding ratio. That means out of 10 customers, we have to fund at least 8 or 9. And every now and then, the reason we end up getting the best promotions and the best rate is because we manage our efficiencies very well. That means we fund at least 80 to 90% of our deals. We're transparent with our clients. We explain everything to them. And if there's a way we can reduce the interest cost, we will do that without you having to ask. With that in mind, the offer looks like at a 4.89%. If there's something better available, I will do my best to maintain it. But at this point, 4.89, should I go ahead and press the trigger? Should I go ahead and request it? Should I go ahead and consider it a confirmed deal at your end? Now, all I have to do is go back to my lender and figure out how quickly we can get that commitment going for you. So all these ways of committing a customer on the A and the B side work very well. And you will always have that very small percentage. If you do it by the book, you're going to learn to do it by the book, and you'll learn not to waste your leads, because you don't like it. We don't like it when you lose a customer. It's a lot of effort down the drain. For you, we can chalk it up to a learning curve, but with us having 100 agents, it's 100 learning curves. That's not a business model we're into. So for that reason, make sure your client is committed before they say okay to requesting a commitment. When you are requesting a commitment with an A lender and the client decides to back out of it, the last resort is, Mr. Customer, at the time when you completed the application, you were required to complete a consent. We charge $1,500 to every client for any reason where they, out of their willingness, decide to back out of a deal. Should they not be comfortable with the deal, they should not have requested the commitment. But because you did, we talked about this, there would be a fee applicable by the brokerage to you. Now, if that ever happens, call your underwriting team and talk to them about how you can address that. We don't want to complain. We don't want to generate a negative feedback out of it, but we do want to hold the customer accountable for the effort that was applied. At the end of the day, self-employment slash the mortgage business is not reduced to, oh, I didn't like your rate, I'm going to walk away. When you get someone to paint your house, you got to pay them. The same level of service that you applied towards addressing their needs, walking them through the options, all of that is still on the table by you being a mortgage representative or mortgage advisor or mortgage agent and being a professional. There's a cost to your time. So educating the customer along those lines that I've put in 15 hours already. I want to make sure that we get this deal done for you, but I also want to make sure that you're committed to me and I'm committed to getting this deal done for you. So do I have your confirmation? And that's the best way to manage those conversations. Next slide, please. If you guys want to take a minute here and ask me any questions, I'm happy to answer them. Just going to take a look at Q&As if anything popped up. GST in Alberta. GST in Alberta. All right. This is for everyone, newbies, not newbies, people who've been in the industry who know how lending works can chime in with this. but I think it's an important education and a good reminder. You will experience problems, and I'm finding it more evidently. Like before, you don't know any better until you've seen the other side, and the other side to me is the U.S. And when I look at how easy and streamlined their process is, sometimes I wonder how we're doing lending in this country. But it is what it is. We got to put the food on the table. We know how to operate the business. We've done this for a very long time. Issues will arise. There's no other way to do this. Um, as a contrast, since we talked about the US market for a second, the US market, if there's a financing associated to it, most likely will not fund a deal in under 4 weeks. Sometimes your closing date can be as much as a month and a half, 2 months, 3 months. And depending on who the lender is, they will define their closing date for you. And realtors know better. And this is again a professional lacking in our realtor community, where they try and rush the deal to make it happen sooner rather than later. But real estate agents in the US operate under very strict guidelines that they have to receive a confirmation from the mortgage broker before they can actually have the client commit to a certain date. And that's one of the reasons why none of the closings that you do end up being anything less than 30 days. 30 days is their rush. That's how slow they operate until title is cleared, until all the covenants are in place, until insurance has been issued by the title agency. They don't process. So coming back to our lending system, the lender review doesn't have an exact time frame. So for private, it's fairly fast. For B lending, it's excruciatingly painfully long. And depending on lenders, it can be more or less intrusive to you and the client. So how to manage that conversation, how to keep your client in check, very difficult and very important to learn. Expected exceptions, an important angle. Every file is not going to grant you an exception. The lender is not going to be okay with an exception on every issue. Oh, the credit score is slightly low. Can I get an exception? No, this is the criteria. Oh, my GDS TDS is a tad high. Can I get an exception? Not really. Oh, my closing date is fairly quickly. Can I get an exception on this? Can I get someone to jump on right off the bat? Lenders have a lot of files queued up. There's a reason why the banking and the mortgage industry is the way it is, which means it's very profitable. There's more of a demand of financing than there is a supply. That's why even the smallest lenders, including us, end up thriving in an environment because there's such limited capacity of lending. So when you're talking about a product with MCAD, for example, when you're talking about a product with B2B, these people have reduced the interest rates by 10 to 20 basis points compared to the competition for a reason. They're doing so because there's some loophole somewhere. B2B will take a tad longer, and sometimes the tad can be 7 days, 5 days. B2B does have a lot of flexibilities for its employees. They work remotely, they work offline, they work at odd hours. Same thing with Scotia. And how many people are you really going to go back to and question whether they're working from home and whether they're actually doing the 8-hour shifts or not? Fact is, they're going to take as long as they will. And sometimes that can be a couple of days or weeks. So know that it can be expected, and exceptions don't apply on every single file. So that addresses your timeline. How is it that you manage that expectation? Mr. Customer, we are in a busy market. The rates gone down, and we've seen large influx. And that statement is true no matter when you're saying it, whether you're saying it in the winter, whether you're saying it in the summer, whether you're saying it beginning a new year. Like, the only time that we actually find things are slowing down are when the rates are ridiculous high, which have been over the past 6 months. Things have been relatively slower when the market was a little slower. Otherwise, it's always been backed up. And even now, just a real case scenario experience, our B deals are taking anywhere around 3 to 4 days for a pickup, at least 3 to 4 days for a review and an offer, another 4 to 5 days for review and a document condition approval, and then another 3 to 4 days for your funding date and instructions. So with those timelines, if just imagine one of the underwriters is away on a vacation, then what? What if the document specialist was on a vacation or had an issue where they couldn't attend work for like 2 or 3 days? And that happens quite often. So those are the reasons why educating the client, Mr. Customer, we're in a busy season right now. Things have just started opening up. We're asking you to be patient. Generally, the approval timeline for A deals is about 24 to 48 hours. That means you should be telling them at least 1 to 2 days. However, 90% of the times we'll come back with an approval the same day. Sorry, I apologize. Within 24 hours. And then the remaining, if there's an issue, if there's an exception required, then it takes a little longer. It travels up the chain of command. It goes to higher authorities for approval amounts. And once that comes back the chain, it could be 3 to 4 days. I'll use TD as an example. TD is TD is underwritten by First Nat. And though I don't use First Nat because they have their own concerns around getting files done, but we do have access to First Nat. That said, TD will still send out that file to my apologies, let me rephrase that. First Nat Underwriting on behalf of TD will still send out that file for an exception to an actual employee of TD, and then it goes up the management, travels back down with the exception, and then eventually comes back. That turnaround for the exception can be as much as 10 business days. So prepare your client ahead of time. Rates. Unless your rate has been confirmed using a pre-approval, there is no such thing as a rate hold. None. Unless your client works with you, completes all the paperwork, you have everything that you need to be able to submit a pre-app, and you go ahead and submit a pre-approval on a certain property, which can be later changed. Unless you have something in black and white that confirms that rate, there is no such thing as a rate hold. So if you're looking for a rate hold, there are two ways to do it. If you know the client's going to be shopping around and you're just looking for affordability and that's it, then you have your pre-approval system that the rate shop system generates for you. It sends out an email to you and manage your client's expectations accordingly. If you're looking for an actual rate hold, then you better have all the paperwork in place so you know this is a committed customer, because pre-approvals can also, for some lenders, count against your funding ratios. Process changes. So I'm going to use B2B as an example. B2B requires all your documents to be submitted for your approval up front. And they can ask for anything and everything, including your NOAs, even if you're salaried. They may want to look at it just to confirm that there are no outstanding taxes on it. So educating the client that, listen, this lender has its own processes in place. This is what we require to get things in an organized way to be able to submit it is important. We've also covered additional information at the same point, but additional information can also point to clarifications. So just because you're submitting documents doesn't mean they're not going to be able to pinpoint a $7,000 credit on your TD Bank statement on May 5th, which shows up as a branch deposit, and there's no sourcing to it. So that's a flag. Anything over $3,000 is a flag under FINTRAC. It's, again, I want to be factually correct. So to a banking institution, when you're depositing the money, a flag is $10,000. I think it's $8,000 or more at this point. However, to a mortgage lending institution, a $7,000 entry into an account where you don't know the source is has to be defined. So don't expect the underwriter not to come back to you and ask you for that additional information. So if you're amazing at your job and if you catch it ahead of time and you were able to ask the client, hey, before I submit this, what exactly is this $7,000? Can you give me a backup on this? and you get that back up, or you get a check copy or something like that that proves it, awesome. But if it's going to go to the underwriting, expect that delay and just the communication. It's an absolute pain. Just sending out a message using the portal takes up a day of you sending it out one day and then someone else responding it to another day. We don't use phones anymore. I end up using phones to connect with underwriters because underwriters will call me to talk to me about a deal that's in question. 9 out of 10 times, it's via email and on portals. What that means is every single one of these lenders has got their own portals where we key in an instruction or key in a note, and then they have to pick it up, and then the alert pops up in their email system, and then they have to log in and they have to look at that update. The point I'm trying to make is it's additional work. It used to be as simple as, hey John, file number 12121. What's the status? I'm working on it. I just need this. Can you send it out now? Yeah, I'll send it out. So that only tends to happen nowadays with files that are close to a closing date. And we still do it. We still escalate it. We still get the job done. But that doesn't mean that's always going to happen. We had a case scenario where the file was supposed to be closing the next day, and this underwriter was just not responsive. He would only work from 2 p.m. to 9 p.m. And we didn't know how to connect with him. Every single time it's going to voicemail. So those delays are to be expected. You're not going to get John every single time. You're not going to get Tom every single time. So underwriters change. We have a certain number of dedicated underwriters for certain lenders because of the volume that we commit to. But that doesn't happen in every case. For Home Trust as an example, Home Trust offers 110 basis points. Why would we go there? We have better options like Foku and RMG in Ontario where we can actually fund faster and get a bigger commission. So I'm going to use Foku as an example, a very concentrated 4 to 5 man underwriting team that's constantly cranking out deals, easily accessible. But try getting an answer back from one of the bigger lenders. So those are the concerns that you need to manage with the client ahead of time. And just like I'm sharing with you, and this could be an eye opener for you, open the eyes for your customer too. They're buying into this. They're buying into the Canadian lending system, which is what it is. There's a little bit of a contrast because there's a sales approach as well as helping the client understand that this is still a better opportunity compared to you walking into a bank and getting it done. And I'm going to be honest, if a bank has your bank statements in your account anyway, they already have a TD card, TD Easy card, and they already have a relationship with you, and they're seeing your salary credited into the account, absolutely, they're not going to ask you for bank statements. They have it already. They've seen it already. The underwriter has gone into that account and looked at the payroll deposits coming in for the last 3 months. But when it comes to RMG, it may ask for that additional information if for any reason that paycheck is being deposited in the form of an actual check, which is a biweekly deposit that you're putting into the account. So using that example, banks do have it a bit easier, but that's where your value and customer service comes in. What that means is, I use this example all the time. Try calling your banker who's working on that file at 10 p.m. or 11 p.m. At night to get an answer just before you're ready to put in an offer. It's not going to happen. They're 9-to-5ers. They're not you. They're working with you as a part of their customer service angle, whereas you are committed to that client success. You're committed to that deal. Your revenue and your payout is attached to a successful execution on that transaction. And that speaks for itself. When your client is comparing you versus the bank, the rate cannot be the only thing that you're discussing. It has to address all the points, customer service angle, the frequency of what you're going to communicate, the guidance that you're going to offer. I use this as an example, and I'm spending a lot of time on this because these are concerns that come up ever so often. When a client comes back to me and talks to me about a down payment, I'm yet to see a client who actually has everything queued up in a perfect way, the exact same way I want it. Every single time a client is going to have a TFSA, another RSP, which has $1,500 sitting in it. He's going to wait till the last minute to get the redemption done. We're going to need that paperwork to come through, and we're still going to need to show a deposit going into the accounts, into his checking. And then we have to show the last 3 months. And with TD, we need to show 3 months of down payment proof from the date of the actual purchase sale agreement signed. And we still have to show the deposit sourced from another savings account for the wife. So all that mush has to be organized, has to be put together. So that coaching that I offer my client is my best advice so that the client doesn't have to suffer. No banker goes out of their way to do that. They just send out a condition and request it, and then just keep requesting it until it's provided, until it's done. Because the onus is then on the client. It's as simple as, you haven't provided me with the paperwork. But when you're working with the client, it's your responsibility as well as the client's responsibility. So that makes you a team in completion. That also points to communication. You keep an ongoing communication with your client. I strongly recommend your Nano system so that you have your two-way SMS going through. If you guys haven't already done so, use the app. The app is known as Lead Connect. When you have that, you can respond to it just like a regular text message. You're connected to it real time, and that's the communication style clients are expecting. Immediate response. And if you're managing that, there's no way to beat that level of service. Securing your fees. This points to when you're experiencing delays, you can't drop the ball on making sure that your fee is covered. So this points to sending out a letter of direction to the appropriate lenders, to the appropriate lawyer for at the time of closing so they can actually pay you out. Securing your fees also includes having that conversation ahead of time, letting them know that this is what, the expected fee is going to look like. And those conversations can help you avoid last minute hiccups. There are a lot of conversations that happen last minute if you haven't been transparent with the client and you're leaving that 1% bomb for once the commitment is in. Don't chance it. They may not sign it. And it's going to further delay the entire process. So you've got a commitment in your hand. You're following up with a client for the 5th time, and he's not signing your approval. And then he's shopped around in the meantime and then comes back to you and says, okay, fine, I'll do it. That just ate up 7 days. So helping the client understand at that time, Mr. Customer, we're a team. We're going to work on this together. If I have your cooperation, close this in about a week to 2 from the date of the closing, from the date of the commitment. However, it has to work both ways. So when I ask you for something, you send it out to me real time, I'll get on it right off the bat. Next slide, please. Okay, working with the underwriter and the lender. So when we talk to you guys about your interactions with the underwriting team, part of it is set up in a way that you get a glimpse of how you're going to be speaking with your lenders as well. And I have relationships with these guys for the last 10, 15 years. So please don't use my conversation styles as a model for what you should sound like. I talk to them like buddy. We've spoken n number of times before. I can yell at them, they can yell at me. It's an open relationship that way. When you're being introduced, they want to know you're professional. They want to know you're organized. They want to know you have your ducks in a row for the file. So if you're expecting that call and if you sent out the notes asking, hey, can you please call me back on this file, and you end up miraculously getting a call, because that happens seldom, make sure that you're addressing the point and your understanding of the underwriter's position with the lender, who is positioned in a capacity to safeguard the lender's interest. I'm going to say that again. The underwriter is working for the lender. That means he's not going to go out of his way to make this happen for you. It doesn't matter if it's your client or not. That's just the way it is. The sooner you learn that, the better it's going to be. Your job is to find a medium ground so you can politely explain to the underwriter a perspective of how this file would make sense, or how you can request an exception, or how things could look on the brighter side. And the reason I'm sharing that is because when lenders will ask for documents, there's no ifs or buts. You either provide it or you walk away from the deal. And your education with your client, again, goes back to this level of information so that you can educate the customer, Mr. Customer. This is how the lenders operate. Just like an example that I shared with you about the FINTRAC flag that occurs at $8,000 for in-branch deposits, and for anything over $3,000 that we require a backup. We meaning lenders. So for that reason, that's an education. The client should and will understand, if you explain it, that because of the rules in place, this is why they need this additional document. If you have it ready ahead of time, this will help me to expedite the process on the file. If the file is ready to be completed, that means that the file is fund ready. What that really means is once you've completed the file to submit, it's all the conditions have been completed. Once they mark it complete, then only will the file be ready. There's no point in talking about instructions or the lawyer receiving paperwork or anything along those lines until the file becomes fund ready. So complete the conditions, work with the underwriter all the way up until they've marked it complete. Marked complete is basically a terminology that we use, or fund ready that we use, to advise everyone, including the customer, that your entire set of conditions have been completed. This is as far as the broker conditions are required. You may still have solicitor conditions applicable, which means your instructions are going to be sent out or have been sent out. And the lawyer is required to work on those conditions to complete the transaction as well. This is the time when you work with the underwriting team, if they're the ones that are helping you complete the transaction with the lender, or you work with the lender to fulfill the file based on whatever they need. So speaking with the customer when you're working with an underwriter, your timelines, your communication, your attitude, finding solutions, there's no other way to do this but to work together. You're not going to get paid with a frustrated attitude. The underwriter can't do anything. They're held by the mandate that they have by the lender to work within a criteria, or whether it's your underwriting department. There's no fixing this. There is just working together and understanding that this is the way lender operations work, and this is what we have to deal with, and this is what we need to work with to put food on the table, which means to derive a commission out of it. So the best bet that you can work off of is managing your client. I have a client who we've talked about, a home trust deal that's been sitting in the pipeline for a couple of days now. That client calls me every single day and checks in with me, and I text him in the morning letting him know, hey, we're going to follow up again today. We haven't heard back yet. And I do that every single day, and I'll continue doing that until we get a response. And today we got a response, so my communication with him tomorrow is going to be, hey, we got a response. I'm just waiting for an update. I'll let you know. So that communication on an ongoing basis will help you. Again, very important, technology. Don't get inundated with your own personal messages, because when you work off of the Nano system, you have a dedicated text / voice line, and then you have your own cell phone to worry about. So instead of having to juggle two, work off of one system, keep your private line, use it for only communication on with private parties or with lenders or with family. That's the best way to operate, so that all your notes and all your communication is standardized and visible in your CRM right off the bat when you're communicating. You can also train the system as an automation to respond accordingly if there are certain negative responses and positive responses. So that should also play well to your benefit. Next slide, please. Lovely, great conversations. No one likes these conversations. Let's be honest. You guys have to understand what's happening with the market before you try and get customers through the gate. You're going to have the rate discounters that operate as big companies that employ salaried individuals, and they have a significant turnover. And I know that for a fact because I've worked in call centers and call center environments all my life. So that turnaround and that burn is so high that people who operate in those True Norths or Butlers don't actually stick around for a long time. And those salaried individuals are the ones that are dealing with the customers on a daily basis, where per file intake or per file commission looks like anywhere between $300 to $800 on average. So if I enter into the business with my level of expertise or the training that I've received or the skill that I've built up, and if I do a transaction for TD for a customer doing a purchase for $1 million with an $800,000 mortgage amount, and if I walk away with less than $7,000, shame on me. I'll do something else. That is where your conversation with the customer comes into play. That is where your relationship with the client comes into play. Managing that expectation can be hard, but it's not impossible. The way to manage that conversation is, Mr. Customer, my job is to secure the best rate. The best rate is based on whoever we go with. If you're choosing a bigger bank, rates are going to be generally slightly higher in comparison. Or you may only be able to qualify within a certain program, which is only offered by these big banks, which is why your rate looks like this. And many times it's a misunderstanding issue, because what they're really comparing is their 6.1 is being compared to an insured mortgage rate of a 4.89. So when that conversation starts off, identifying where the gap is, whether it's about the rate, whether it's the accuracy between the rate that's being offered versus what it should be, or eventually where the program difference may apply. We've had scenarios where the client is being offered a 3-year deal and we're offering them a 5-year deal. Clearly, the 3-year deal is going to be slightly less in comparison, and the 5-year deal is going to be slightly higher because of the term. So identifying the product similarity, making sure that that's the exact same rate that they're looking to. And then even then, once you've done all those checks and balances, the results still may be inconclusive. Go ahead, find out how a client can produce a document that says a 4.69 when the market going rate is sitting at a 4.89. So it's either a buy down or it ends up being a fabricated document, which isn't unheard of. We've had scenarios like that where customers will come back and provide us a document saying that this is what my pre-approval rate is. And then when we verify it, it's just not an option. It's not available in the market. Or there have been instances where a customer was working with Meridian and he ended up getting an excellent rate. And we didn't work with Meridian, and Meridian didn't offer the products to the broker channel. So we're left with nothing. There was a time when Meridian was offering an excellent rate, and Butler was the brokerage that was facilitating that transaction, and they were making $150 per file because Meridian doesn't work with the broker channel, and they were only referring the business. So yeah, it's amazing that they were basically just sending out that deal, but that's a special relationship that you don't have access to. You can only sell products that you have under the banner. You cannot sell products outside the banner, which is why understanding what is being offered everywhere else is an important knowledge that you need to maintain as well. So rate conversations, very challenging, but identify the concern first. Is it a lower rate? Is it the program? Is it the fact that you're comparing fixed versus variable? Is it a different offer that you're working with? Is it a monoline lender? Is it a bank lender? And probing those questions can get you to the actual grid of why the client is looking for a different rate. People, including myself, are generally unreasonable when it comes to their benefit. And you're no different. The client's not going to be any different. They will do their best to watch out for themselves. It's what human nature requires and demands of you. So for that reason, if someone were to quote a 4.69 when the world is sitting at a 4.89, talk to them about what other options could apply to help them out, reduce the interest rate. 9 out of 10 times they want to work with you. That's why they're still having the conversation. What they really want to know is when you call Rogers, what you're really looking for is a discount on that package. You don't want to quit because you know Bell's the exact same thing. TELUS is as bad as the next company. So what you're looking for is a discount or a relationship opportunity. So if it really ends up being a $500 discounting on the package, pay it out of your commission so you can save the deal at least. Don't nickel and dime on that. If you're making $5,000 and if you're just being requested to drop it by, let's say, 5 basis points or 10 basis points, even that shouldn't cost you more than a couple of grand. You're fine. You can manage. At least you got the deal. You created a volume for yourself. You can move on. What you're opening up as a chapter is that client is happy with you. You can ask for referrals from that client, from that customer. So discussions of rates typically should be done on the phone or in person. When you're having a conversation around the rates or wanting to commit a customer, so there are two instances. One, when you're committing a customer ahead of the commitment, and then past the commitment. So if you're sending out past the commitment, you should have already done a quick review with the customer that this is the document I'm going to be sending out. Please sign on this page. Make sure you initial here, and this is why the rate is there. However, Mr. Customer, if there's a drop and if there's a way for us to reduce that rate, we will go to every extent and see if that's possible. And 9 out of 10 times, if there's a rate drop, the lender will automatically reduce it for you, so you're covered. And if there isn't a rate drop, then we can always request a rate drop on that deal. So if you're showing a different rate on the commitment, give them the comfort of knowing that, listen, if there's going to be a rate reduction, we'll cover you in every case scenario. Addressing the rate concern and frequently asked questions. So frequently asked questions around whether I'm going to be able to port, because when the rate pops up and they're actually serious, a lot of other questions pop up. If they're serious about getting that rate and signing off with you, they're looking at, is the payment going to make sense? Is it bi-weekly or monthly? And that is where the distraction comes into play. And I call it distraction because there's no other way to get you guys to understand that that's a redirect of conversation. The distraction is when you're talking about the rate, address their concern about the rate, and then talk about other things related to that deal. For example, Mr. Customer, are you sure you're still okay with a 5-year deal? Are you still okay with staying in that property for the duration that you initially committed? Because I'm not worried about it. If I have to go back and change a few things to make it happen to your benefit, I will. But tell me now, this is the deciding point. And in my conversations and in underwriting conversations, because they've been trained exactly like that, it's more about having a conversation about the deal as opposed to just the interest rate. Interest is just one of the 5 or 10 things that we discuss on a call when we are ready to have them sign off on a commitment, just before we send out the commitment. An important thing to remember with certain commitments is, I'm going to use B2B as an example and TD as an example, and this does apply in many cases as well. So many of the deals that we have in the pipeline right now, where you've seen a rate reduction on BOC, is going to, in perhaps a week to 2 weeks, once the market stabilizes, trigger another reduction. We don't know if it's going to happen within the next 2 weeks, or it could be a little longer, but it will happen because the stocks, the bonds are going to react to the reduction in the overnight. And that also points to how much of a reduction, because there's going to be a cap of what they can do. Yeah, they cut it by 25 basis points, but they were borderline about it. Fed hasn't, the US Fed hasn't cut it. And our economy is entirely relying on that ecosystem for trade, for business. So if you've seen the news, the loonie already dropped a bit. And those are the reactions that you find based on how rates fluctuate up and down. So if your client has received a commitment where the interest rate is, for argument's sake, 4.99, and if the rate has gone up, then you're set. You're done. You're happy. You're committed. However, if the rate goes down, then the system will TD, and if it's a sizable loan, then we have pull and we have leverage where we go back to head office and we say, listen, I'm getting an offer of X, and X has to be reasonable. X has to be documented in some way, shape, or form. And we can validate that online or based on an RBC offer, or TD, or a Scotiabank offer, or a client relationship with another lender that we can use as a reasoning. When we go back, head office will then authorize First Nat to issue yet another commitment. And that is why the education has to be done. Mr. Customer, if you see a typo, if you see an issue, don't worry about it. This is a lender commitment that just authorizes us to start completing the file. So when you sign on this, the lender is committed to this funding. Yes, the rate is important. Yes, the content is also important, but it's not the end of the world. You will be receiving an updated copy closer to the closing date, which will be generated by the underwriting department, which will come back to you for another signing. And at that point in time, you can validate all those checks and points. You don't have to stop signing because there's an L missing in your first name. You don't have to stress out over the fact that your interest rate came back at a 4.94 versus a 4.9. If 4.9 is what was committed, then go back to underwriting or check with your lender to confirm if that's what the case is, and they will moderate it for you. Sometimes lenders make mistakes. We've had a scenario where the rate was 4.94 instead of a 4.99, and they issued it on a 4.99. We got the sign off done, and then we sent it back, and then the client, and then the underwriter generated another commitment to reflect the updated rate. The lenders will work with you very well once you come back to them and satisfy them and prove to them that their hard work has paid off. Everyone has statistics to maintain related to funding, whether it's an underwriter, whether it's you, whether it's the underwriting team. So when you go back and commit that deal, the underwriter will work back and forth with you to get whatever the client is looking for, because we are all looking for a positive experience at the end of the day. Next slide, please. Rosalie, why don't you take over the rest of it? My throat's killing me. No? Okay, I'll continue. All right, retainer conversations. No, I'm joking, my dear. It's all right. I'll finish it off. What slide are we on anyway? 11? Okay. All right. Sorry, was there another slide before that?
Yes, Ari. This one.
Okay, awesome. Retainer conversations, very important. Private deals, very important. 70% of the business in 2024 is so far and will continue to be private. And you can dodge it as much as you want to. It's not going to change how it is. Your retainers are based on effort applied. We all know there are dozens of private lenders out there. And that's the number one reason why you need skin in the game. And that philosophy of skin in the game extends to anything and everything related to mortgages. If you have a customer who is qualifying for a B deal and does not want to order an appraisal, you have no way to hold him down. He's going to be here, he's going to waste your approval, and he's going to walk away. And the simple reason is your client is expecting and is in a mental mind frame of sixes or fives or low sevens like it used to be a couple of years ago. Nowadays, private deals are coming back at eights and nines. So there's no way you can protect yourself at the same time and not have the client pay for the appraisal so that his skin is in the game. So when you're doing a B deal, it doesn't matter. The first thing that you do is do the appraisal. And every single time you're going to find that you don't do an appraisal, you're going to backfire it on yourself, because had you done the appraisal, you would have had more control over not just the client, but also the value because of the file, the structure of the file. There are situations, especially in this market, where the value comes back lower. And then what? You're requesting an 80 LTV. He's shy by maybe $50,000. Where do you think that additional money is going to come from? Home Trust won't allow a second behind you. Equitable won't allow a second behind you. They have a mandate from OSFI anyway. So that's, again, a reason to educate your client. Mr. Customer, we need to do an appraisal to better understand the value. There's a lot of up and down in the market, and though what you may feel could possibly be true, we need it on a validated report. So once we have that actual number, we know exactly what numbers we're working with, so we can get you the funding that you need. And, Mr. Customer, don't you want to know if there's a shortfall? Or would you rather find out a day or 2 days before closing? Would you not want to know how to manage that problem today so we know what we're looking into in the future? So those kind of conversations can help you for either an appraisal or for a retainer that you collect ahead of time. So we don't collect retainers on B deals. We try not to, unless a client is absolutely bonkers. He's just like, we see 11 different hits from 17 other brokerages, and we know that this client has gone everywhere. There's no ifs or buts. We're asking for a retainer. Take it or leave it. And anything over $400,000 is fair game for a retainer, so that applies. And don't be shy. Reach out to the underwriting team. Ask them for help. You're not going to end up funding a deal. If you're doing deals by yourself, we don't want to cut in it. We want to protect you. So if it really comes down to a point where you want to protect yourself and you need the retainer to be placed in play, then have them send out $500 or $1,000 to accounts@rateshop.ca. It gets electronically deposited as an email money transfer directly into our accounts for that specific purpose. And we will also issue a receipt or a confirmation that the retainer has been reserved, which you can forward to the customer as well. So working along those lines for anything over $400,000 is always recommended. But if you've got the appraisal, many times you're going to have the appraisal and people are still going to walk out. You know, at the end of the day, it's just an appraisal. But nowadays it's a little harder because people understand that appraisals are costing a lot. Like HPI appraisals on $1 million property value are going up to almost like $650, $700. That's better than a $500 deposit that you're going to accept from a client. So for private transactions, it's a step further. For private transactions, not only do you need the retainer, you also need a confirmation. Sorry, for private transaction, not only do you need an appraisal, you also need a retainer to make sure that what you are sourcing is something that the client's actually going to be committed to. So this is where I draw the line. This is our recommendation. Whether you apply it or not, this is entirely up to you. By the time you've done 100 deals, you're going to learn that this is the business that makes you money, and time means money. That's one of the reasons why you don't want to be wasting time. So clients that are just talking to you for hours at a time and not yielding anything is a waste of your time or my time, which is why we draw the line and we figure out, are you serious or are you not serious? And the serious ones will pony up every single time, and the ones that aren't serious will walk in the opposite direction. And that's okay. If it comes down to that, that's okay. I can read some of the questions that you have in your head. Well, Ali, easy for you to say. No, easy for you to say as well. If you're working on something that's not eventually going to pan out, yes, it's a good experience, but you can do that in a role play. So if it really comes down to it, get paid for the time that you're spending. So What does the law say? We've discussed anything over 400 grand is what's recommended. If we are a part of the lender equation, which means we have a right as a lender, the lender as LendMax Capital is an example of a mortgage investment co that is run under the offering memorandum of Ontario Securities Commission. It does not report to the provincial regulator, which is FSRA. So if the lender requires an advance to commit on the deal, then the lender has a right to request that amount. Now, you as a mortgage agent may not be able to request that. You should never touch money. You should never accept a deposit. There have been people fired over that. There have been people that paid $25,000 in penalties over that. I was just protecting myself. You can't do it. The brokerage can, you cannot. But if there's a retainer involved by a lender, then you're safe, because what you're really doing is you're collecting the retainer and the email goes directly to the lender, and the lender is the one that acquires that money, and you're not touching the money. You're not in non-compliance. It's a 100% safe method of ensuring that the client is going to be connected or committed. And that retainer, I've had other brokerages, a very small percentage, because you're always going to find a few that don't agree with you or don't want to follow the process or don't really align with you. So out of, let's say, 100 deals that we've done in this year, we have maybe 3 that came back. Oh, I don't understand. Why are you asking for a retainer? That doesn't make any sense. What am I supposed to tell my client? What am I supposed to, like, should we not know what we're agreeing to? Or should I not have access to the term sheet before I do that? No. It's a $150,000 deal. This is what the interest rate is. This is what the lending fee is. These are what the terms are. Take it back to your customer if he's interested. There's a cost of the administration of the file. This is what it's going to be. If you pay up, we'll get it done. If you don't pay up, walk across, go somewhere else. Simple as that. And again, easier said than done, because these customers are the ones that are actually going to backfire on you. When the commitment comes in, 50% of these deals fall apart. If you go back about 3 or 4 years ago, actually, let's go back further, 5 years ago, people did not like doing private mortgages. And the reason for that was that the deals that were coming through, because the rates were on the lower side, they were a little more competitive as a product. Like Home Trust had its line of credit. Why do you really need a 14% of a cost of borrowing when Home Trust can offer you that at 8 or 9 or 10? So when the products were there, the private lending was a 50% hit and miss. Now it's a little more structured, and everyone has a request for a retainer to protect their time and interests. So whether it's Ginkgo, whether it's CMI, whether it's MCF, whether it's Neighborhood, FisGuard, all of these guys ask for a deposit. Capital Direct wants to talk to the customer before they can actually issue you a commitment to see whether they're not. They don't trust. You want to go direct to the customer to see whether they're going to be okay to issue the commitment before they issue a commitment. But those are examples of how the industry has changed, and that's why we got to adapt too. So different ways of asking the customer, Mr. Customer. The requirement for the retainer is so that we can commit the deal. Once the deal is committed, then they can send out the instructions as well. That also has a cost to it. So obviously they're covering their base, because when they retain a lawyer, the lawyer is also going to be charging a fee to make sure when he's doing your title searches, when he's doing your document prep, he's not going to not get paid. So the lawyers also have a cost that has to be borne. So this is part of the cost that covers that. In some cases, it doesn't. Sometimes there's an additional fee that's required, but in most cases, $500 to $1,000 is applicable for a legal retainer or a lender retainer to be able to process the deal. Next slide, please. Okay, how to commit a customer. Techniques to gain customers' commitment, ensuring customers' confidence in their decision, time to think, exploring other options. So I think we touched on this, but very quickly, because I'm trying to make sure you guys are out of here by 5 p.m. The logic behind creating more than just one offer is important. If you have more than one offer available to the customer to present, then the customer understands that you've gone to the extent of getting another option for you. Options. It's a sales strategy, a very common practice. It's psychology. All of that plays well when I'm perhaps looking at a fridge to purchase. I'm going to look at a Samsung, and I'm also going to look at an LG. I'm going to compare the two pricings. So when you're working with the customer, really the rate shop puts you in a good spot where, listen, we shop for you, so you don't have to. We have access to all those lenders, so you don't have to jump through the hoops. So though TD is offering you this, and many times you're going to be dealing with a much better product compared to what you can offer. So if they have a TD offer or publicly available, you're getting $1,000 cash back, or you have an X interest rate being advertised, Mr. Customer, one of the reasons why, for example, I'm going to use RMG, is more prominent and a better deal is because they don't have higher costs of operation. They don't operate on a branch system. Yes, you're not going to be able to walk in and collect a statement, but you don't need to do that anyway. That's why they have an online setup where you can simply download it. And that being said, it offers additional flexibilities where we have a relationship with the lender. If at any point in time we want to go back to them and negotiate on a rate for a renewal, we can do that. If we want to request them a line of credit, we can do that. If you want to request an enhancement on the current product that we have, we can do that. Those are the reasons why I prefer this product. Time to think. On your approval, you're typically going to have a 24-hour timeline or a 2-day timeline on the cost of borrowing document that you should allow the client in retrospect of, this is what we're offering you. If you want to proceed with it, then please sign off here and we can continue with it. So even if you sign off on that, you still have 2 days to think it over. That's just the way the law works. However, if they don't sign off on it, that means we cannot push forward that commitment to the lender until they have signed off on it. So it creates a delay. So imagine a customer who's already running behind and wants the file completed as soon as possible. The best way to manage that conversation would be, Mr. Customer, I've gone ahead and waived that time frame for you. If you still have any questions, let me know. I'm happy to walk you through the approval again. But this way I can get the commitment back sooner and I can start completing the conditions so we can work together on completion of the file or market file complete or conditions complete. So that is one strategy to try and work with so that you can get the sign off done immediately. Another strategy would be, Mr. Customer, we don't know where the rates lie as of right now. I would rather commit you to this interest rate so that if there was a fluctuation, you're protected. And if there's a drop, you're still protected because we can still go back to the lender and get a reduced interest rate on it. So those ways, and there are many other ways, and I don't want to keep going on this point, but think about creating a safe haven for the client when you're talking about committing the customer. A conversation like, well, if you don't sign, you're just going to be sitting there and I won't be able to do anything. That's not the approach I want you guys to take. So working with the customer, helping them understand why it's important, helping them understand what a commitment really means. A commitment is the lender's confirmation that they're going to fund to you, provided these conditions have been completed. Next slide, please. All right. This is a part of setting expectations. And again, we've touched on it a little bit, but I'm just going to do a quick revision because there are a couple other points that we can address. Why are you still asking me for these documents? And this is a question that we hear not just from the clients, but also agents. And what's really happening is that the clients bringing down their frustration to the agent, and the agent is bringing down their frustration to the underwriting team or the lender. And many times I've been in that spot where I go back to the lender and ask the lender, really, this too? And though I know the answer to that, it's still annoying, but this is how you manage it. At the time when you're signing off the paperwork, put in an insert of a verbatim script. Mr. Customer, this approval obviously is dependent on the conditions that we complete. Every now and then, there are files when the underwriting is reviewing it or completing your conditions. There may be something pending, or maybe there's a clarification required. And give them an example. I had a scenario where the client had a down payment that was going through, and it had a large amount that required additional backup and paperwork to it. So I just want to make sure you're going to be okay for me to ask you additional paperwork. You and I are working as a team. I want to get this done. I won't ask for anything that's unnecessary, but if it's required, it's required. And like what they say, the guy who's holding the bag of money is the one who's monitoring, is the one who's dictating what's required. So until the lender is satisfied, no matter which lender it is, whether it's TD, RBC, CIBC, or us, we will still need the paperwork to complete this. So for that reason, do I have your commitment? Do I have your confirmation? If I request something, it'll come through. That communication puts you in a good spot where you can easily say at some point in time, Mr. Customer, remember when we had that chat about asking for additional paperwork? Now, whether or not you're going to need it, this is a good practice. You should be doing it on every single file, because you never know how or which file can sway in the opposite direction. So the idea is to educate the customer ahead of time, so that that mentality is towards you is friendlier, not frustrated. We already explained that to you. There are very difficult files that I've done in the past where I tell the client up front, listen, we got this exception. This doesn't mean the day is over. And I actually use the statement. I say, it's not done until it's done. Until you receive funds, don't thank me yet. And that has proven true, because every now and then the lender is going to come back and ask for one more item. And if you want to fund the deal, there's no other way to do this but to provide that paperwork. Now, sometimes you can manage with a clarification. Sometimes you can manage with a comment. Sometimes you can manage based on your own response. Maybe you know the customer on a personal level. You know the answer to that question. Send it off, expedite it. There's no point in avoiding the document. If you cannot answer the question 100%, if you cannot provide the document, go back to the customer and request it. It's going to be easier that way. How do you request that paperwork? Don't push them through the hoops again. This time, they already uploaded all the paperwork on Finmo. This time, just requested, hey, it's going to be easier. Why don't you just email it and work off of the email and send it out right off the bat so that it's done and over with. Obviously, review the document before you send it out to the lender. I've had scenarios where the client sent out something. For example, it was a debt paid, and the debt paid is as simple as an agent clicking on the forward button, sending it out to the lender, and yay, we're done. And you're expecting, okay, well, we should be done. The statement that was sent out doesn't have a name, it doesn't have an account number, or it could be a mobile screenshot, or it could have one more problem within that list of transactions where, yeah, it proves that $15,000 was taken out for a payment, but you have a $17,000 entry coming into the account, which is a bank deposit, which you don't know what the trace is. So working on that document and knowing what you're sending out is very important too. Next slide, please. Okay, setting expectations on rates and timelines. Mr. Customer, it would take approximately 2 to 3 weeks from the commitment for us to complete the deal. That's an average timeline. If we can push a little harder, we're going to do that. Everything is on a rush at our end as well as your end. It's just assumed. We don't collect the document and sit on it for 24 hours and then say, it's cured a bit. Let's send it out now. We send it off the moment we receive it based on priority series and what we're working on. So those are the concerns that have to be addressed ahead of time. Mr. Customer, we're going to be working on this file. The sooner you get our paperwork in, the sooner we can fund that file for you, and it's going to be easier on you as well. Managing customer expectations effectively is important. So let's just quickly talk about realistic timelines. Realistic timelines are for private transactions. Lenders, including LendMax Capital, says 2-day funding. So though we've had some scenarios where everything just happened to line up and we did funding in 48 hours, it's not common, and it's not something that you can expect or share with the client. So educating the client on a private transaction, you're looking at least 5 to 7 business days. On a B transaction, you're looking at least a month. On an A transaction, you're looking at least a month, provided everything else is provided. Every document has been submitted ahead of time before the submission, so that the down payment angle is covered, the income angle is covered, any other debt management issues are covered. And you're still going to have a couple of transactions that are lingering behind towards the end, because you have to sometimes pay off debt. You have to manage GDS, TDS. You have to figure out whether the property tax was mentioned on the MLS or not. And all of those factors come into play to make sure that you're doing your job right by educating the customer. Next slide, please. Okay, so how to request steps to securing customer sign-off. When you have received your approval, whether from the lender or from the underwriting team, you're going to set it up on Finmo and you're going to request electronic signing on it. It's the easiest way to do it. It's important. Every single agent for the first commitment, in some cases more than first commitment, but first commitment goes through what the underwriting calls a review of the commitment. So the underwriting's responsibility is to go through the commitment with you page by page, where the relevant spots are, so where you know the signing is required, and to make sure that you know what to educate the client for, where to sign, what's a collateral charge, what's a blanket, what property values were associated to it, how does the fixed rate apply, has there been a mention of how the line of credit is going to be, what amount the line of credit starts off at. Those things are going to be mentioned on the commitment, and we will share that with you. Once that is done, you set up the approval, you send it back, you get on the line with the client. If they want to do an online signing while you're on the phone, bravo. If not, let them read over it and finish it off. Always tie in a timeline. I have to get this out back to the lender. How soon can you get this out? Obviously, I want you to read up on it, but if you can get it in by today, I would appreciate it. We've discussed what a commitment means. A commitment is a confirmation by the lender, provided these conditions are met, we will issue you this financing. It is contingent on those conditions. Appraisal is a big one. The rest of them follow on the next pages. Legal requirement for disclosure review. So cost of borrowing disclosure, very important, required document for every single transaction, no matter what program you're looking at. We've already talked about addressing timelines and urgency. If someone says, I want this funded tomorrow, or many times we feel, we always recommend use one of your lawyers because it stays contained. And if you're not using one of your preferred lawyers, then the lawyers will also create an instance of urgency. And what they're really like, everyone's out to make a good impression of themselves. And they want to retain the business. They want to create a relationship. There's no better way to make yourself shine than putting the next person down. And if you're not working with a cooperative real estate agent or cooperative lawyer, that will backfire on you. And it is important to draw the line so that we show ourselves as professionals and experts, so that we can tell the client, educate the client, no, Mr. Customer, this is the process, this is the way to do it, and this is why I'm letting you know ahead of time. I tell all my clients ahead of time, if you're going to be using one of your lawyers, I don't guarantee a timely closing, but if you're using one of mine, I trust them with my life. I know what they do every single time. if something were to go sideways, then my lawyer is going to call me before he calls the bank or you. How does that comfort you? How does that protect you? The answer from the client is, Ali, whoever you want to use, just let us know, we're going to use that guy. So that covers those angles as well. Lender's action on assigned commitment. So once the commitment has been received by the lender, now they start assigning the file to perhaps a document officer, or sometimes it's just the underwriter who's completing the file, but it puts in queue. There's a certain amount that gets dedicated and allocated towards that customer deal in the system. And now you have a committed customer. Now that amount has been reserved for that specific date, which is very important because sometimes lenders do run out of money as well. Optimal timing for sending commitments, next day. Ideally, send it out as soon as you can. If you can send it out the same day, beautiful. If you can't, then communicate with the lender so that the lender knows what to expect. Don't sit on it. Your relationship with the lender is what's going to make you money. This client is done. He may or may not come back to you. Your relationship with the lender will continue. So for that reason, watch out for the underwriter or the lender you're working with, so that you can manage that relationship in terms of good communication as well. Follow-up procedures for post-commitment. If the commitment has been sitting for, let's say, a day or 2 days, first off, you already outlined a timeline. You told the client, listen, Mr. Customer, there's a 2-day timeline or a 1-day timeline to accept this, and then send it out. The sooner you do, the sooner I can start completing the conditions in the file. For that reason, please let me know if we can get this going right away. Beyond that, if for any reason the commitment still lingers, deadline. Mr. Customer, just wanted to make sure, are you still committed to this deal? Because we have a contract. Or are you still committed to this deal? Do you have any concerns around it that I can address? So have that conversation, open up an avenue so that you can get on the phone and talk, because texting at that point in time is useless. You need to be on the phone, be talking with the customer, so that the communication style, the tone reflects whether the client is thinking a positive or a negative. So those important angles can only happen in a real communication or a real phone conversation. Next, please. Important one, how to ask for referrals. So customers that have worked with you, you must ask for a review before the funding kicks in, because everyone knows there will be hiccups in the closings. If not in all of them, at least some of them. Don't lose the opportunity to ask for a review or a referral. So, Mr. Customer, I'm hoping that you've been happy with the overall structure of how we did this. I'm just glad we worked as a team and got this done. I would love for you to refer me to someone that you feel I'd be able to service. It means a lot to me, and it would be a validation of my my services to you, or my attachment to you, or my connection with you as a customer. Leveraging satisfied customers for new leads. So, Mr. Customer, it would mean the world to me if you can leave me a review. It would help my business, and it would allow me to serve other customers, and it motivates me on a daily basis. The underwriting uses, when they're cranking out deals internally, it would mean a lot to me. We get compensated by the level of customer service that we offer to our customers. We're hoping you can leave us a positive review. It always comes back with a positive review. Next slide, please. That's it. Thank you so much for being a part of this presentation. People who attended, greatly appreciate it. I'm hoping this has been a positive learning experience for you. I am still holding strong on the requirement for all sessions to be mandated. People who are jumping out should not be jumping out, and there will be accountability associated to it. So I'm hoping you guys understand that when we're putting out time and effort and energy, it's for the purpose of you learning more and taking in the experiences that we have, so that you come into you face less problems. We're always there to help you with a phone call, but these learning environments are better because they're more efficient. I can talk to you individually, and I would have to speak with you on 15 different fronts to get the amount of information out that I did in this 2-hour session. So it's easier for us to do so in a larger setting, which is why this is the only way for us to train. So perfect attendance is greatly appreciated. We're doing this for you. I already know this. Underwriting already knows this. So we're wanting you to learn out of this equation. Thank you so much for being a part of this. We'll see you next time. Ciao.